hello to those of you on the live stream. Okay, I'm going to give everybody 30 more seconds before we start. And during that time, I'll take the opportunity to introduce myself. My name is Andrei. I am a partner on the distribution team here at 500. I'm actually based out of LA. That's why you guys haven't seen me yet in person. I come up here once a week. My background, I tend to describe myself as a UX-focused, user experience-focused growth marketer. I'm a former scientist, having worked in biology, life sciences. And before 500, I worked at a couple of different companies on growth, most notably at Hulu, the online video platform based out of LA. So I helped launch and scale the Hulu Plus subscription service there. I worked in the music space as well at a music subscription company, and I briefly ran growth at a mobile video startup named Vidi that was also in LA that I'm going to talk about here a little bit. So, all right, who's ready to talk about metrics? Woo! All right. So let's level set. Why are we talking about metrics today? Well, as you are starting your journey here at the accelerator, one of the most important things that you need to establish as a baseline before you can figure out how to grow is whether you are growing, right? And to determine that, you need to be able to measure what you're doing, right? So the point here is that we want to make sure that you are thinking about the right KPIs, key performance indicators, right? That you are thinking about defining an OMTM, your one metric that matters, right? That allows you to have laser focus in your business, and to make sure that once you've defined those key metrics that you're measuring them properly and accurately, and that you create accountability both for yourself and the rest of your team, right, in terms of figuring out how to scale your business and growing it effectively. The one caveat that I'm going to throw out here before digging in is that this is not intended to be a crash course in statistics. So I'll be touching on a couple of points that are statistics related. If these things are unfamiliar to you, please feel free to use this resource that you may have heard of called Google to dig in and familiarize yourself with things that are unfamiliar. Okay, so I'm going to start off this conversation around metrics and OMTM with a cautionary tale. So Vidi, the mobile video startup that I mentioned just a little bit earlier, was back in 2012 poised to establish themselves as the Instagram of video before Instagram had video. It was a very hot time in the space. Instagram was blowing up. Everybody was going gaga over photos and photo sharing apps. And the founding team at Vidi thought, hey, why don't we create an app that will do what Instagram's done for still pictures for video? So they embarked on this process. They had some early success and luck, which is always important. So they were one of Facebook's first open graph partners, which gave them some huge opportunities in terms of getting in front of a large audience. And they capitalized on that very effectively. So they figured out a growth hack that allowed them to basically drive users to, or prospective users to register in order to view the videos that their friends had created and shared from Vidi through Facebook. And that became their main focus, is registered users, okay? Something that most people think of as a vanity metric. Now, they also were sort of in the right place at the right time. So they got off to a really solid start in terms of driving this registered user growth as an open graph partner. SocialCam was the only other video-related startup at the time that also had that access. So there was very limited competition. Instagram was blowing up. The Vidi team managed to raise a $6 million Series A as they were going on this trajectory. Just after that, Facebook announced the acquisition of Instagram for $1 billion. Everybody collectively shit their pants and then started FOMOing about what they could do in the video realm. Meanwhile, Vidi's registered user graph kept scaling like crazy. They got to over 50 million registered users. And within 30 days of closing their Series A, they went on to raise a $30 million Series B at a $300+ million valuation. then you can probably imagine what the rest of the story entails. Facebook decided to tweak their algorithms around Open Graph and how content was being surfaced, and Vidi's registered user growth curve plateaued and then crashed out. So I came in not long after that trying to help them get on the right course, trying to help them focus on actual actionable metrics and get them back on track. But there were a lot of mitigating circumstances there that ended up eventually leading the company to have a 30% RIF. That's a reduction in force, eventually returning $18 million of what they had raised to their investors. Rebranding, to the best of my knowledge, not ironically, to Supernova, and then getting acqui-hired by a company called Fullscreen in LA. And I would argue that a lot of the sort of the missed opportunity here came from the fact that they weren't focused on an OMTM that was relevant, right? Like, it wasn't about registered users. The problem for Vidi was that people were being forced to register. They weren't actually engaging with the app, and those that were engaging with the app were only doing it once effectively because there are too many steps, too much friction in that process. So with that as the cautionary tale, let's talk a little bit about the one metric that matters. So the real premise around OMTM is grounded in this notion that focus is really critical, right? So you can track dozens, if not hundreds, of metrics through your Google Analytics, Mixpanel, whatever analytics tools you're using. But the goal of the OMTM is to be a metric that ties most closely to the factors that tie into the growth of your business today, right? And this is one thing that can be a misconception for folks is that, oh, if I define my OMTM, I'm going to be stuck with this for the lifetime of my company, and is this metric relevant now? Will it be relevant in a year or 2 years? You can change your OMTM at any point, right? So the real intent here is to find the metric that is most relevant for your business now. If that changes in 3 months or 6 months, nobody's going to hold you back from making that change internally. The other thing that's very important here is that the OMTM should be a metric that you can influence directly. If I were to ask just for a quick show of hands, how many of you guys would instinctively want to call revenue your one metric that matters? How many would do so today? Well, any kind of revenue. The point being that revenue is not something that you can directly influence, right? Like, revenue is an output. You can raise prices, that's true, but for most people, there are other metrics, right, that drive revenue, right? Like the number of leads, the conversion rate through your funnel, all these other elements, right? So revenue for most companies is not a metric that you can directly influence, right? You can't go out and do X experiment tomorrow that directly impacts revenue. There are other sort of factors that intervene. The other aspect of the OMTM that's critical is that it forces you to define success, right? So sometimes talking to founders, they have very different ideas about what it means to be successful. Again, going back to this risk around vanity metrics. Is it page views that count? Is it number of downloads that you're getting from your app? Is it number of leads in your pipeline, LOIs that you have signed? It also focuses your entire team, and it also creates an environment for you that supports scientific experimentation, which is really the foundational aspect of growth, right? So you heard Chandani talk a little bit about that. You'll hear more about that process throughout this week. So let's talk about what makes for a good metric, right? So a good metric is comparative, right? So this is very simple, but ideally your metric is something that you can look at today, that you can look at in a week, 3 months, 4 months, and be able to get a consistent view around your business through the lens of that metric and how it's doing. It's understandable, so this is something that cannot be so abstract or complex that folks on your team have a hard time understanding what it is that you're exactly talking about. Ideally, it's a ratio or a rate, because ratios are metrics that are the most actionable, that allow you to understand what's going on and allow you to make change. And it's an enabler of behavior change, right? So again, you're looking for things that are actionable, that your team can rally around and say, okay, our widget metric, whatever it is up or it's down, right? This week over last week or over the last month. This is what we need to do, or this is what we can do to take action and get it going in the right direction. So needless to say, metrics come in many different flavors. And so the right metric that is most relevant for you and your company really depends on what you're trying to measure. So some of the attributes of metrics that, again, this is very basic, but just to level set, you can have qualitative versus quantitative metrics, right? So you may be out there talking to customers, for example, and you may ask them, well, why did you like or didn't you like this aspect of your experience, whether it's the sales experience or the user experience or whatnot. And that's a qualitative metric, right? You're getting very, very granular insights from a handful of users, but it's not something that you can necessarily analyze or extrapolate from. A quantitative metric by comparison would be your NPS score, for example, your net promoter score. So that's where you're going out there. You're still trying to get at the same set of notions, right? How happy are your customers with the experience that they've had, but you're actually quantifying it. You're using a process that allows you to put a number against this happiness indicator and be able to compare it across time, across cohorts of users, et cetera. Then there's vanity versus actionable. I already touched on this, but again, vanity metrics are high-level numbers that really aren't directly connected to the health of your business, such as page views. Basically, most metrics that you read about in major tech publications, I hate to say it, tend to fall into vanity metrics because everybody's trying to optimize for the biggest sounding number, right? So I've had X million of page views or X million of downloads of my application, but what you care about is, in those types of scenarios, how engaged are those users, right? Or did they just come to the site? Did they take action? Did they purchase? Did they register, et cetera? Then you also have the question that you have to answer for yourself of whether you're looking or you want to look at leading versus lagging metrics. So again, in the context of, let's say, consumer or customer satisfaction, a leading metric would be just that, right? So assessing your customer satisfaction maybe through an NPS survey. That's a leading metric. It gives you a sense of how people are feeling ahead of there being any noticeable impact on your business. A lagging metric in this case would be churn rate, right? So let's say that you've launched your business, you have this great service, it's off to a great start, but as you scale, quality tends to suffer, and you would first see customers starting to feel dissatisfied, right, with the level of service that you're providing them. And if you don't mitigate that, and be able to bring their satisfaction back up, then you're going to see a resulting increase in churn because people are going to say, fuck this isn't working for me, they're not hearing me, they're not providing me with value. And then there's also the classic correlation versus causation issue, which trips a lot of people up when they're thinking about metrics. So a very basic illustration of this, thinking about, let's say, a standard consumer website, you could be thinking about your conversion rate, and you could be thinking about how that changes across the day of the week. And you could say, oh, geez, people are buying my widget at a much higher rate on Sundays than they are on Wednesdays. And you could be tempted to take all sorts of, draw all sorts of conclusions from that, when in fact, that's really just a correlation, not a causational element, because of how consumers engage with the internet for personal reasons. A causal dynamic may be more related, maybe better illustrated by looking at bounce rate, for example, and page load times, right? So if you have a really slow-ass site and it takes forever to load, you will see the bounce rate go up because nobody has the patience to sit around for half a minute for a page to load. And now there's this question of one metric, like why just one metric? Can I have more than one metric? The answer is that ideally you would be able to pick one metric that you can really focus on that is indicative of the health of your business. And that allows you to achieve not just focus, but also clarity. But depending on your business and your business model, there's nothing wrong with having secondary metrics that you're also considering. And the reality is that for most businesses, you're going to have effectively what's a pyramid of metrics, right? Like you're going to have this OMTM that sits at the top of the pyramid, And that metric is going to be driven and influenced by a whole slew of other metrics, secondary metrics, tertiary metrics, et cetera. And depending on how complex and how large your business is, how large your operations are, you're going to have people within your team who are looking at these other more granular metrics. But at the end of the day, you want to be able to boil things up to just one metric that you can look at very quickly any day of the week and very quickly assess the overall health of your business relative to what it was, let's say, yesterday or last week or last month. So there's nothing wrong with having additional metrics. My recommendation would be that you force yourself to stick to 3 or less additional metrics in terms of high-level KPIs that you're looking at, on a regular daily basis. And in terms of thinking about how to structure the sort of the delineation between your OMTM and your secondary metrics, it really again comes down to the nuance of your business. So for example, if you are in the business of selling widgets, for example, you may be debating the difference between looking at the conversion rate in your funnel as your key metric versus AOV, your average order value, right? And again, which one of those two metrics is the most important really depends on your business and how you see the life cycle of your customer. So another topic that I want to weave in here is the notion of OKRs. Now, all of you guys have heard us talk about OKRs. You've gotten emails from your DPOCs about OKRs, your objectives and key results. And people may be wondering, well, why do I need to define these? Can't I just define my metrics and focus on those? And the fact is that OKRs are really, an OKR framework is an enabler for your metrics and what you're doing to drive the growth of your business. Right, so the objective here, and again, most of you guys have seen this and hopefully already done it, but just to review it, you want to define your goals for your business. What are your goals today, for this quarter, for this year, for the duration of this accelerator batch? And you want to quantify those goals, right? So you may have some high-level sort of subjective goals that you want to hit, but then you want to quantify them so you can gauge your progress against those goals, right, on a weekly and monthly basis, and then be able to contextualize your experimental work. So ideally what you want to do is once you have your OMTM and your other supporting KPIs defined, you want to hold yourself accountable, right? You want to measure those numbers every week. You want to sit down in your DPOC meetings every week and look at those numbers and take a very hard look and say, okay, we're flat, let's say, this week over last week, and over the last month, we've actually gone down 5% in aggregate, right? And that sort of realization should drive you to think deeply about your experimental pipeline, right? So what you want to be doing is continuously testing different hypotheses around what drives growth for your business or what could drive growth for your business. And that's a constant game of prioritization and reprioritization. So if you're testing things out there and they're not moving the needle in terms of your OMTM, that is a strong indicator that you want to go back to your list of hypotheses and your experiments and rejigger what you're working on and how you're spending your time, right? With an eye on that OMTM so that for the next week you can say, okay, we've moved the needle, right? And that number is up. So now I want to talk a little bit to you guys about specific metrics, and most of these are relevant for both consumer businesses as well as SaaS businesses, right? So whether you B2C or B2B. So customer acquisition costs, something that I'm sure you guys are familiar with and have thought about, are hopefully tracking and measuring. I tend to think of the customer acquisition cost metric as the iceberg metric, right? Like this is one of your most fundamental indicators of whether you're in a position to sink or swim, if you will. So some of the considerations you want to keep in mind as you are defining your customer acquisition cost and calculating it is, one, whether it's blended or segmented, right? So what's really important in your business is that you understand what the key acquisition channels are for your customers, and that you understand what the performance is in each of those channels. And what you're constantly going to be facing is the dilemma of sort of the volume, right? Quality versus quantity. You may have channels that can drive a ton of leads for you, but those leads tend to be more or less qualified versus channels that are super high quality, give you really strong leads, but there aren't that many of them, right? And for most of you, realistically, you're going to have to find a balance, a compromise solution where you may have a mix of channels, some that deliver quality but lower quantity and others that do the opposite, or having to pick between one or two channels at the outset and make a hard call which one of those two are most important for you at this stage of the business. And as you'll see, the quality of the lead is obviously tied very closely to your acquisition cost. So the less qualified, the more it's going to cost you to actually acquire that customer. And most companies, at least in the early days, tend to talk about acquisition cost and frankly any high-level metric on a blended basis, right? They're looking at their overall number of customers that they've closed in the last week or the last month, and then just doing a very basic calculation and going, oh, our blended CAC is, let's say, $15. But what you want to be able to do is look at the individual channels, right, and segment that metric and be able to tease out the nuances, such as, your blended CAC may be 15, but 60% of your acquisition may actually be essentially free and maybe a referral or word of mouth. And then the other part of it that's paid may be actually, much higher than that average of 15, right? You could be looking at, in some instances, hundreds of dollars, right? The spread can be really large, and you need to be able to understand that so you can prioritize where you're spending your resources, both your time and your capital, in terms of driving acquisition. The other important thing to consider about your acquisition cost is whether it's fully loaded. So I've seen many companies out there that, for example, have a hardware product or a widget, right? And that could be an actual physical thing that's manufactured, or a good, like, let's say, coffee or other sort of consumer products like that they distribute, and they may be leveraging a free trial as part of their business, right? So there's a sample. And I've heard numerous companies talk about, like, oh, our acquisition cost is zero. We have this free sample that we send out, and it does really well. People love the product, and then they just come magically and they sign up. And they somehow sort of discount the fact that that sample, for most of them, not all, but for most of them, that free, quote-unquote, sample, free to the customer, is something that incurs a hard cost for them, right? So you want to be mindful of that, free trials and for samples. So in terms of free trials for non-products, for services, I mentioned earlier, I worked at Hulu, so we had a free trial at Hulu, and there was cost to that, right? So we had, Hulu's a content licensing business. We had to pay the content owners of the video that we had on our site. We had to pay them a certain amount per minute watched of their content. So as we were offering consumers, let's say, a 1 week or a 2 week free trial of the service, there was an actual hard cost to our business for consumers watching content during that time. Then you also need to think about your retention or your reactivation costs, right? So let's say it costs you a certain amount to get your customer in through the funnel the first time around, and they may order your product, they may use your service for a period of time, then they may go dormant and deactivate. And then you may need to go out there and reactivate them, re-engage them in some manner. It could be through email marketing, it could be through offering a discounted promotion, it could be through inviting them out to an offline event that you're doing, things that may involve actual cost. And as you're thinking about customer acquisition cost and you're thinking about your lifetime value, or LTV, which we'll talk about in a minute, if you think about the LTV over the course of, let's say, a multi-year span with that customer, you need to be mindful of any sort of reactivation or reacquisition initiatives that you have during that period, and that needs to be factored into your total acquisition cost. Also, PR or other marketing-related costs, if you're doing promotions, if you're doing stunts like Ubering kittens or ice cream across town, like these are things that, again, factor into your acquisition cost, and you need to include them in your calculations as you proceed. So LTV, lifetime value. This is what I like to call the elusive metric. This is something that you will get asked about by investors, by all sorts of folks, like, what is your LTV? How much money do you make out of your customers? The reason why I tend to call it the elusive metric is that LTV is something that can become really complex to calculate accurately, and this tends to trip up a lot of companies at one point or another, right? So the typical formulation that you will see out there and that a lot of companies use is just this basic notion of, oh, my LTV is my monthly revenue times 1 over my churn rate. The challenge is that churn rates come in all sorts of different formats and dynamics. And if you use the simplistic formula, your LTV may be off by more than a factor of 2. There's a quick and dirty methodology that you could use, which is basically defining your LTV as your monthly revenue times 1 over your churn rate times 0.75, right? And that gets you a little bit closer. But even then, like, you may need to apply an additional haircut of 20 to 30% to be safe, right? Like, you ideally want to be conservative in your LTV, because ultimately your LTV is going to set a ceiling of sorts for your acquisition cost. So if anything, you want to estimate a lower LTV right up front so that you don't feel too overconfident in terms of how much you can spend on acquiring your customers. But the fact is, if you want to be really rigorous about calculating your LTV, you're going to need to get deep into your statistics nerd out and use what's called Bayesian modeling. And so again, this delves into a realm that I'm not going to cover in detail today, but I will share the slides with all of you guys, and there is a link there that gives you a little bit more information, and you should feel free to dig into that if this is something that is of interest to you. The bottom line, though, is that you need to keep in mind is that in the early days of a startup, no matter how much statistical firepower you throw at this question, the fact is that you need a certain amount of data before you can even attempt to calculate an LTV, right? So let's say you're pre-launch or you are 3 months into launch. It's unlikely that you have enough meaningful data to be able to calculate an accurate LTV. So given everything that I've said, I'll sort of contradict myself mildly, and I'll put out there that while LTV is a very important metric for you in the early days of a company, it's probably not something that's worth getting super anxious or obsessive about, because you probably won't be able to really get at the true quote-unquote number anyway. So it's more important that you are familiar with the fundamentals, know how to calculate it, know what the implications are on the rest of your business, how much you can spend to acquire customers, and really focus on executing rather than getting too like anxious and having to like highly granular debates about the statistical merits of different formulations. One thing that I'll throw out there that, again, it's probably a metric that you guys have heard that you're familiar with in terms of how you think about balancing your acquisition cost and your LTV. So there's a rule of thumb out there that is used by a number of different folks, a lot of investors who basically like to say that they want to see your acquisition cost be no more than 1/3 of your lifetime value. Again, I would think of that as a very general rule of thumb. There are also investors who like to peg that ratio at 1/5, right? So you give yourself more headroom, if you will. And I don't think that those numbers are off necessarily, but there's always nuance to these things, so you want to be mindful. Obviously, if you are figuring out that your acquisition cost is basically equivalent to your LTV, you have a problem. It definitely needs to be lower. As to how much lower, I think there's always room for debate. The other thing that, again, is a very basic element, but I'll just throw this out there. In terms of your LTV, you have to keep in mind that you're not talking about top line here. This is a mistake that I've seen a number of companies make, right, where they're looking at the total revenue that they're making for the customer and using that to derive their LTV. LTV is basically the profit that you're making, right, off of your customer. So keep that in mind. So in terms of that ratio, that CAC to LTV ratio, so again, that's one way to think about how much you can spend to acquire a customer and how profitable your business model is. But ultimately, it's the payback period that is the more pragmatic metric in this instance, because what you care about really most from a cash flow perspective is if you're spending X number of dollars to bring in a customer, how long does it take for you to make that money back, right? Is that payback period something that happens within, let's say, the first transaction of the customer? Is it something that happens within the first month, 3 months, 6 months of you having that customer as a paying customer? Or does it take a year or 2 years to make back what you spent on acquiring them? The nice thing about payback period is that it's something that's relatively easy to measure, right? You don't have to wait necessarily for months and months of data the way that you sometimes do to calculate an LTV accurately. And ultimately it's a crucial metric as you're thinking about balancing profitability of your business and your growth, right? What basically the payback period allows you to understand is what the steady state of your business is, right? So if you have X number of dollars that you can put against growth or customer acquisition, however you want to define it, you're going to be constantly cycling those dollars, right? You're going to be spending on acquiring customers, and you essentially want to know how long are those dollars out of your pocket before they come back in and you can spend them again to drive additional growth. So churn rate, one of my favorite metrics, the keystone for me, right? So this dictates your LTV in a number of different ways. This again is a nuance also, or a metric rather, where there's a lot of nuance, and there are multiple ways that you can calculate churn rate. Here's a hint. The simplest way to calculate churn is not the best, nor the most accurate. And the best way to calculate your churn in many ways sort of comes down to what sort of churn you have, right? So there are generally 4 types of churn, and again, there's a great article about this that I've linked to here that you guys can check out. But churn essentially can be classified into constant, increasing, cliff, or annual renewal. So just to break it down very basically, a constant churn is just that, right? It's churn where when you're looking at it on a month-over-month basis, you're seeing more or less the same amount of drop-off from your customer base. Increasing churn is churn that, just as it says, is going up month-over-month. Cliff is basically a churn dynamic where you see a lot of drop-off early on in the customer life cycle. So maybe in the first 1 or 2 months, you're seeing a good chunk, maybe the majority of your customers, your subscribers, dropping off, but after that it levels out. It may be flat or very close to flat. And then annual renewal, if you're in a situation where you're charging annually as opposed to monthly, then your churn dynamics are going to be very different, right? So for customers who are on annual plans, you're going to see that churn more or less be flat, almost zero during the 12-month interval, and then you're going to see a spike in churn as you get to that 12-month window. So yeah, question in the audience?
Yeah, just a question around how to structure experiments. So we're signing annual contracts right now. I would like data on churn for all of those. So any sort of thoughts or guidance on how to run experiments, maybe segment out a certain number of customers and run them on quarterly or monthly or your contracts, is some data there, or any other sort of hacks to get out of that?
Yeah, so I'll just repeat the question. The question is around if you are running a business where you are billing customers on an annual basis, how can you, in advance of hitting that 12-month mile marker, how can you do experiments? How can you do some predictive analytics to try and infer what your churn rate will look like? And there is no sort of simple solution. Because it's very hard to draw inferences as to what a user or customer behavior is going to be like on that sort of a plan, depending on your business, and I obviously don't know the details of yours. Depending on the business and your price point, of course, there are a lot of merits to being able to support multiple types of billing billing plans, right? So having a monthly, quarterly, and an annual, some people feel like is ideal. Now that can create complexities on your end, on the back end, or in terms of accounting and whatnot. But for a lot of dynamics, especially on the consumer side, which you may be B2B, but on the consumer side, having an annual plan and having that sort of lock-in is great. You also get that more sort of upfront revenue, but you also have to think about the price point, right? Like you're talking about a 12x potential difference in price, although most folks will offer a discount for annual plans, so let's call it a 10x difference. And you have to think about the perception in the customer's mind in that regard. Usually what you'll see is the churn dynamics for a monthly recurring subscription model are going to be very different than with an annual. So it's very hard to sort of make an inference. But I would, if it makes sense for your business, I would definitely advise you considering doing a test for a segment of your audience to present them with that option of monthly versus annual. Yes?
And if you don't have a subscription model, is this relevant at all? Or like
Yeah, so if you're not deploying a subscription business model, which could be either consumer or could be SaaS, like a SaaS is subscription, then churn isn't really relevant because it's a different dynamic, right? So in e-commerce, if you're just selling, widgets a la carte, then there's really, for most of those types of businesses, there's no expectation or dynamic established where the customer comes back and purchases on a regular basis, right? So it's really up to you to figure out how to drive that re-engagement, right? Like whether you want to push like new products, new SKUs that you're offering to them, or offering them alternatives, alternative products, ancillary products, upsell, sort of cross-sell opportunities. So churn is relevant as a metric mostly in the context of subscription. Yes, another question in front. So let me make sure I understand the question. So if you have a subscription model, but one where your customers tend to drop off after a few months and then they come back in, so I think you still want to stick with the basics of tracking and reporting on your churn rate. Obviously, if there is organic reactivation, if you will, that's another key metric that you want to track and count. But ultimately, and again, I don't know what your business is per se, but what I would want to look at very closely is understanding what's driving those customers to churn out, and is there a way for you to mitigate that, right? Like, is there a way for you to keep them around longer, right? Is it a seasonal issue? Is it that there's a lack of sufficient product market fit? Is it something else? And also in terms of the reactivation of those customers, obviously an important consideration is whether you're having to spend money to reacquire them or whether they're coming back of their own accord. The latter obviously is ideal, so you don't have to incur additional acquisition costs, but I have seen businesses where there actually is a fair amount of organic sort of reacquisition. You would probably expect questions from investors as to why you're having that churn and how you can mitigate it, especially if customers are coming back, because that's a sign that they do like or love your product or service, but for some reason there's something that's pushing them off. Like maybe it's a pricing issue, maybe it's a seasonality issue, but that's how I would sort of think about it. Yes, question in the back. Are there other ways to think about customer value pre-revenue? Yes, there absolutely is. I think the question is whether there's a tangible way to think about it, which I think is tough to answer. But of course there is value. I would think about that value in multiple different ways. So to the extent that your business is subject to network effects, then I would say having users on your platform, if you will, using your service or your product is important because it'll create that network effect value. Even if you don't have necessarily tangible network effects, I would say that if it's a product that has any sort of social dimension to it, right, where users are aware of how many other users are using the product or the system, then again, there's value because it's just social proof, right? Like, am I in an empty room or a packed room, right? As a sort of a coarse analogy. And then, of course, there's also the matter of word of mouth and referral, right? So you may be pre-revenue, you may have a product or a service that you're offering for free because you don't feel you have product market fit or you can't ramp up production, whatever the reasons would be, but that you're still in a situation where your customers are engaging with your product and service, right? So that allows you to build brand, both with them, but also to leverage their satisfaction, their experience to evangelize on your behalf and drive customers. So even though you're not monetizing them, there's an opportunity for you to leverage those customers to essentially drive acquisition for you, new customers for free or very low cost. So that's the way I would think about it. Yes, another question in the back.
Do you have a preference for user or account churn versus baking in things like additional revenue from the same account growing out? I've seen kind of two metrics around that. Do you have a preference for each one?
So, sorry, repeat the question for me. I want to make sure I understand it.
Do you have a preference of more simple churn, like number of users or accounts, versus including where you're growing an account more of a revenue churn.
Yes, absolutely. So that's actually you're allowing me to segue to my next point, which is negative churn. So thanks for bringing that up. Let me talk about that in a second. One thing I want to say really quickly about churn rate. I know I haven't talked specifically to methodology here. One thing that I would recommend as you think about how you're calculating your churn, most folks tend to calculate it. So let me back up. Churn typically is most meaningful to look at on a monthly basis, right? That's because daily or weekly churn is not really that interesting, and annual churn, frankly, is just too long of a time period to be meaningful. So most folks tend to look at it on a monthly basis. The challenge is that obviously different months have different durations, and so that may end up causing trouble for you as you're transitioning, let's say, from January to February to March, and could lead you to have a whole bunch of freakouts, and maybe more importantly, your investors having a whole bunch of freakouts as to why your churn rate is bouncing all over the place. So what I would strongly recommend that you consider as you're doing your churn rate calculations is to look at a 30-day moving average, right? And that basically mitigates the artifact of the calendar months that's created there. Yes?
So, I know this is very important for our business. If I have a customer churn in January, another customer churn in April, that's, if I'm just looking at the monthly, and that's just one churn calculated for that particular month.
Yeah, that's correct. So if you have a customer who churns off in January and then one in April, like, yeah, that would be one churn event for that particular. Yes, yeah. So again, a lot of nuance in churn calculations, right?
I just calculate the total amount of customers that churned in the lifetime of the company, which is 6. That's how I get 2% churn. But I guess our churn is a lot lower than that.
Yeah, so what you want to do in terms of churn, you want to make sure that it's going back again to like the key attributes of useful metrics is you want to have it as a rate over a time period, right? And so looking at over the lifetime of your company is not that helpful because that tends to be too long of a period for you to be able to accurately gauge what's going on, right? Especially as your company continues to age. You want to look at a meaningful time interval, and the monthly period is what most people tend to look at. But again, I'd recommend doing 30-day rolling average if you can. It's a little bit more intensive to calculate, but it's worth the effort. Yes.
Do you think it's okay to use tools like Chart Mobile and just trust how they calculate?
So tools like Chart Mogul, did you say? I'm not familiar with that one, but yeah, so the question is it okay to use tools that are calculating churn for you? I would say in principle, yes, if you know what their churn calculation methodology is and you're comfortable with it, right? So there's nothing wrong with using tools like that and sort of outsourcing some of the calculation work, but just make sure you know exactly how they're doing it. And the fact is that particularly with churn, there can be a lot of nuance, and companies see this constantly, even when they're calculating it themselves, because you're usually relying on data from multiple systems, right? So you may have data from a billing system, and you may have data from other systems. Like, so I'll give you a concrete example. Let's say you're doing a consumer subscription service. That's what I'm familiar with. Let's say you're using Stripe, for example, to handle the billing, and you're using Mixpanel to run your analytics. So you may have a situation where your payment service provider is noting the churn the day that it happens, right? So let's say somebody churns tomorrow, August 2nd, right? And your payment provider, and this is, I just use Stripe as a general reference. They may or may not be doing it this way, but your payment processor may say, okay, churn event detected on August 2nd. But the fact is that user probably got billed on August 1st. And again, depending on your policy around billing, if it's a monthly billing cycle, it may be, okay, well, sorry, you canceled the day after the billing cycle, so we won't charge you again, but you're effectively still a customer for the rest of August, right? So some of your other systems may not recognize that churn until the last day of the month or the first day of the next one. And so that ends up creating a lot of data headaches for people as they're trying to reconcile how events like that are defined. So that's super important as you're implementing or reviewing your analytics stack, that you make sure that events are properly and consistently defined. Yes, one more question in front. Yeah, so the question is, should all metrics be on a 30-day moving average? I would say it depends. Something like customer acquisition cost is probably not important to have on a 30-day moving average because you usually don't look at it over a period of time. Any metric that is time-based, may make sense to look at it. Again, I hate to give sort of general advice, so I would say it's probably worth looking at exactly which metrics. Churn, I think, is fine to have on a standalone basis, looking at it on a 30-day average. You don't necessarily need to have all other metrics on that time frame unless there are things that you're trying to correlate with churn or looking at in parallel, in which case looking at it over the same time period has its advantages. So I know we're almost out of time. I have only, I think, one more slide. So let me get through this really quickly, and then I'll open it up for any more questions if we have time. I'll let Chandani give me guidance on that. Oh, yeah, that's no big deal. Just kidding. Okay, so just going back to the point from the gentleman in the back earlier in terms of churn. So negative churn, again, if you're a subscription business, if you're a SaaS business, negative churn is sort of the hidden power that you want to unlock in your business, right? It's one of your most powerful growth levers as you scale your business, right? The challenge with churn is that as you scale your business, as your user base grows larger and larger, churn is effectively the drag on you, right? So if, again, very sort of trivial example, but if any of you guys are swimmers, if you go out there and go swimming in a pool, try going swimming with your regular swimsuit and then try jumping in the pool with, fully clothed and try and do that same swim. It's a lot harder, right? And that's very kind of trivial analogy, but that's essentially how churn functions, right? So you need to have a certain escape velocity in a subscription business to be able to scale to a compelling level. And for most businesses, that means that you need to have a monthly churn rate that is, definitely lower than 5%, ideally lower than 3%. So that's a big hurdle for a lot of companies to hit, right? Like that's a relatively low churn rate, so you have to do a lot of things right. And you may or may not be able to get to that 3% in and of itself, but your opportunity to really mitigate that escape velocity challenge is negative churn. And negative churn essentially means your ability to upsell or cross-sell customers, right? So you're always going to be losing a portion of your user base every month or every year. And the way that you mitigate against that is taking your other existing customers that are paying you on a recurring basis and basically make more money out of them, right? So upselling, cross-selling, that helps you mitigate that impact of the customer turnover on your revenue. Now, what's important here, and this goes back to the point that was made, is as you're tracking your churn, you want to track your customer or account churn separately from your revenue churn because you want to be able to glean that insight into how your revenue is doing relative to your accounts. And your maximum churn is effectively your scaling constraint, right? And so you need to understand, this goes back a little bit to the payback period question. You need to understand how much cash, how much revenue your business is throwing off, how much you can reinvest to grow, and how far your cash runway will get you, which is obviously a critical consideration as you're thinking about milestones, fundraising, et cetera. And that is the last slide. So I will take, let's say, 3 more questions. One over here, yes.
We do have negative churn, but I'm having a hard time calculate that. So basically my question is, the churn and the negative churn are 2 different metrics, or should we merge them somehow?
So the question is whether churn and negative churn are 2 different metrics. Yes, I would think of them as 2 different metrics, right? So this goes back to the point of tracking your account churn or your customer churn separately from your revenue churn, right? So I would think of your negative churn more in the context of revenue and tracking it that way, if that makes sense. Yes? Yeah, a good question. So do you consider churn when the customer actually cancels out of their account or when you get to the next billing cycle and they're not billed? So there is no absolute right answer, right? It sort of depends on, frankly, how you want to define it. The thing that's most important is that you're consistent in your business and how you do it. So there are good arguments on both sides. I think the latter probably more around accounting. The former more around being able to take action, right? So if you're in a situation where you feel like you can be effective at rescuing or reacquiring those customers, I would tend to think of that period between when the customer actually cancels, right, or calls you to cancel or emails you to cancel, and the end of the billing period. That's a certain sort of like magic interval where you have the potential to sort of win them back without any negative impact on your business from a revenue perspective, right? And so as you think about your customer retention and engagement efforts, that's probably why I would skew more towards the latter, or sorry, the former, meaning consider somebody churned or canceled at the moment when they click that cancel me button, so that you can think about what you can do during the remaining period of that billing period. Okay, one more question over here in the back.
We've been running subscription service for over a year, and we see statistically that the highest level of churn is the second month. But we've been calculating churn rate as an average from every month per cohort. So does that make sense? Or I guess like how do you find that exactly?
So the question here is that this is a subscription business that's been running for a year. You're seeing the largest churn drop off, or the largest churn spike, I guess, during month 2. Per cohort, right. So 2 months in relative to the sign up date, right? And your question is,
Like, what is the rate? Is this the average of churn over time per month?
yeah, so I mean, you can look at it in 2 different ways. So generally, when you will get questions about your business of what's your churn rate, people are generally getting like, what's your average churn rate, right? But as you think about actual management of your business, the more effective way to think about it is on a cohort basis, like you said, right? Because having that insight and being able to say that there's a huge drop off, relatively speaking, in month 2 is very important, right? Because you need to dig in and understand, why is it that so many customers are dropping off in month 2? Is it that, you know, our product market fit isn't quite there yet? Is it something about that user experience where it's just like in month 2 something bad happens? Is it about the messaging and positioning, that there's just something about the way that the value propositions are articulated aren't quite there, and you have people who in that month 2 sort of see through that, or they get to a point of disillusionment, right? Like when you have a churn drop off like that, it means that there's something that's not quite optimized about your aha moment, right? The aha moment being that point where your customer is like, oh my God, where's this service been all my life? Like I can't live without it, right? And that's really what is indicative of your product market fit. And so for your purposes, yes, I would definitely continue looking at it on a cohort basis, because you want to be able to see, you know, how and if you can mitigate that month 2 drop off, because that's where your engagement drops off, right? Or your engagement probably precedes that, and then the churn is the lagging metric in that instance. So. Okay, guys, I don't want to keep you from your lunch, so I'll wrap it up. If you have any more questions, feel free to grab me, or you can email me. My email is Andrei, ANDREI, @500.co. I should have it on my slides. All right, back at 12:45, everybody. Thank you.